A credit score can feel like a mysterious number that holds power over major life decisions, from getting a mortgage to financing a car. But what exactly is it? And more importantly, what factors are at play in determining your credit score? Let's break down the essentials of credit scores and explore what really affects them in a way that's straightforward, concise, and practical. Welcome back to Resources for Life, the small channel with big ambitions. A credit score is a three-digit number that represents your creditworthiness, or how likely you are to repay debts. It's used by lenders, landlords, and even employers to assess your financial responsibility. The most common type of credit score in the United States is the FICO score, which ranges from 300 to 850. Similar schemes operate in other countries. For example, Experian and Equifax determine scores in the UK. A higher score means better credit, while a lower score signals risk. Your credit score influences interest rates on loans, your ability to rent apartments, and whether you'll get approved for new credit. So understanding what factors into it is key to managing your financial future. There are 5 primary factors that determine your credit score. 1. Payment history. Your payment history is the most significant factor, making up 35% of your total score. Lenders want to know if you pay your bills on time. Consistently paying your credit cards, loans, and other debts when they're due builds trust and improves your score. However, just one missed payment can hurt you. If you're 30 days late, your score can drop significantly, and the longer the payment is overdue, the worse the impact. A simple but sometimes overlooked solution is to set up reminders or automatic payments to avoid forgetting due dates. Pro tip: if you miss a payment, try to make it as soon as possible. Some lenders report missed payments only after they are 30 days overdue, so quick action can prevent it from appearing on your credit report. Please consider a like and subscribe to this small growing channel. We aim to get better and better at bringing you good, interesting, and informative content, and your support, as always, is greatly appreciated. Back to the video. 2. Credit utilization ratio, 30% of your score. The second largest factor is your credit utilization ratio, which is the percentage of your available credit that you're using. For example, if you have a total credit limit of $10,000 and you've used $3,000, your credit utilization rate is 30%. Experts recommend keeping this ratio below 30%. If you max out your credit cards or even come close, it can signal to lenders that you may have trouble repaying future debts, thus lowering your score. Pro tip: if you can, pay off balances in full each month. If that's not possible, as it isn't for most of us, aim to keep balances low compared to your overall credit limit. 3. Length of credit history, 15% of your score. Your credit history length refers to how long you've had credit accounts open. The longer your credit history, the more data lenders have to evaluate your borrowing and repayment behavior. If you've been responsible with credit over many years, that's a big plus for your score. This factor takes into account the age of your oldest credit account, the average of all your accounts, how long it's been since you used each account. While it's tempting to close old credit card accounts you no longer use, keeping them open can actually benefit your score by increasing the average age of your credit history. 4. Credit mix, 10% of your score. Credit mix refers to the variety of credit accounts you have. This can include credit cards, mortgages, auto loans, personal loans, and student loans. Lenders like to see that you can responsibly manage different types of credit. However, this doesn't mean you should open various accounts just to diversify your credit. It's better to focus on responsibly managing the types of credit you already have. While this factor isn't as influential as payment history or credit utilization, it's still part of the equation. Pro tip: don't feel pressured to open new credit accounts just for variety. A healthy mix happens naturally as your financial life evolves. 5. New credit inquiries, 10% of your score. Each time you apply for new credit, a lender performs a hard inquiry, which temporarily lowers your credit score. A hard inquiry typically stays on your credit report for 2 years, though the negative impact is usually minimal and fades within a few months. If you apply for multiple credit cards or loans in a short period, however, it can signal financial instability to lenders. A general rule of thumb is to space out credit applications to minimize the effect on your score. Pro tip: if you're shopping for a mortgage or car loan, multiple inquiries within a short period, usually 45 days, are often treated as a single inquiry, so it shouldn't impact your score as much. This is called rate shopping. Surprisingly, some financial behaviors and activities don't affect your credit score at all. For example, your income. Your salary doesn't impact your credit score. However, it's considered by lenders during loan approval to assess your ability to repay debts. Checking your own score. Soft inquiries like checking your own credit report don't affect your score. Rent payments. Unless reported by your landlord or paid through specific credit reporting services, rent payments typically don't count toward your credit history. Now that we've covered what affects your credit score, let's explore how you can improve it if it's not where you'd like it to be. Pay bills on time. Even if you can only make the minimum payment, paying on time consistently is the best way to boost your score. Reduce your credit utilization. Aim to keep balances low relative to your total credit limit. Paying off credit cards regularly or requesting a higher limit, if responsible, can lower your utilization rate. Don't apply for too much credit at once. Avoid opening too many accounts in a short period to minimize hard inquiries. Keep old accounts open. As long as they're in good standing, old accounts help improve your credit history length. Monitor your credit report. Check your credit report regularly to ensure there are no errors that could be dragging your score down. You're entitled to one free report annually from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion. Understanding what affects your credit score can empower you to take control of your financial health. While building or improving your credit takes time, the effort pays off in the long run. Focus on responsible habits like paying bills on time, keeping credit balances low, and avoiding unnecessary credit applications, and your score will reflect your efforts over time. By demystifying these key factors, you can confidently manage your credit score and use it to your advantage in achieving financial goals. Just be smart about it, and good luck. Thanks for watching.